The stock market has been on an absolute tear for the last year and a half, with global stocks up almost 42% since the beginning of 2023. So now, inevitably, you're going to start hearing from your friends, family, people on the news, online, forums, wherever you are. You're going to start hearing about people saying the market is too high, you got to get out of the market, doing all this crazy stuff. I've talked about this on other videos before, but stocks being at all-time highs does not mean that a crash is coming. Returns 1 year, 3 years, and 5 years after an all-time high are almost identical to returns that we've seen at any other random month over the last 100 years. So does that mean that the stock market always just goes straight up and we should just be blindly optimistic about the returns that are going to happen in the stock market in the future? No, absolutely not. The stock market is volatile and prices go up and down every single day. And sometimes those periods when they go down can last for a really long time. So then when these headlines start showing up of people saying a 10% crash, a 20% crash, whatever, these are all coming. Should you ignore them or should you listen to them? Well, before we go much further, I would recommend that you don't make changes to your portfolio based on a headline that you read, a video you watch, a tweet you see, a friend's comment, especially because these people don't know you, they don't know your situation, they don't know your cash flow, they don't know your timeline, they don't know your goals, they don't know anything about you. So someone's comments or whims or beliefs about what's going to happen in the stock market in the future is just a guess. It's their hunch, it's their belief, but it has nothing to do with you and your portfolio. So please don't make changes to your portfolio based on these situations. But the stock market won't always go up, so you should get mentally ready for that inevitability. Financially ready is maybe a little bit of a different story because people think about preparing for a market decline as market timing, meaning you're trying to get out of the market before it crashes and get back in right before it takes off again. And this is just the absolute loser strategy. It's never going to work. Yes, you might get it right once, you might get it right twice, you might get it right a few times in your lifetime, but the number of times that you get it wrong will absolutely kill your portfolio over the length of your investing lifetime. The experience of a market timer is kind of like Michael Scott on The Office, getting and then reversing 3 vasectomies. Snip, snap, snip, snap, snip, snap. You can never get it right. You're never going to be feeling like you've made the right decision, and inevitably you're going to make the wrong call. So as a default, I'm a believer in a buy and hold approach with a strategic allocation based on your risk tolerance. That's a little bit of jargony word salad there, so I'll explain what that means. So a buy and hold approach means that you pick a portfolio that you can stick with through all weather, meaning whether someone's predicting a crash or everyone's feeling great about the market, whatever, this is your portfolio that you're comfortable sticking with during your current stage of life. And a strategic allocation means that you're setting your mix between stocks and bonds appropriately based on how much risk and volatility you're comfortable with on a short-term basis, contrasting that with the return upside needs and expectations that you have from the portfolio. So if you can handle all of the downs that happen with the stock market, everybody can handle the ups. Everybody wants all the ups. But if you can handle the downs that come along with being an all equity, meaning all stock investor, then maybe a globally diversified portfolio of stocks would be appropriate for you. But if you are someone who cannot handle those downs in the stock market, or your financial situation doesn't allow for any sort of volatility or even just a smaller amount of volatility than stocks, then this is where you can start looping in some bonds to help buffer that downside. But more on that later. But first, let's take a look at the last few decades to see what a normal experience would be in a typical year as far as upside and downside goes. On the chart, we see the blue on top showing the largest gain for the year, and on the bottom in gray is the largest decline for the year, and the dot shows where the year ended, whether it was positive or negative. And almost every year, there are declines from the highs. This is the volatility you hear about, and it is the price you pay for the positive returns that you expect in the future. You won't receive positive returns in every single year, and even throughout every year. This should be your expectation. In every year, there are periods of decline from the highs of that year. So that's the gray section underneath the line in the middle. In most years, that intra-year decline is often 10% or more, even in years where returns end up positive for the year. So when someone says a 10% correction is coming, they're not really going out on a limb. They're simply describing a situation that happens in most years. Sometimes a 5 to 10% decline is all that happens, but sometimes it's quite a bit more than that. Because we don't know when these periods of time are going to come, it's okay to be nervous, but you can't be surprised. As an investor, you cannot assume that these good times will always continue forever. There should be an expectation that there will be declines even in years that are overwhelmingly positive. So it's all well and good for me to say this on a video, but it's another thing to actually experience it in real time. So maybe think to yourself, if you've been investing for even a few years, think about what you did, how you felt, what changes you made to your portfolio during December of 2018, during March of 2020, during all of 2022. That wasn't that long ago. What did you do? How did you feel? Did you get out and try to prevent any sort of losses from happening? If you did, when did you get back in? Did you make any mistakes that you regretted now that you're past those periods of decline? Maybe you didn't, and that's great. But if you're someone who can't handle the typical volatility of the stock market, this is where bonds can come in to help out a little bit. So if we take a look at the graph here, it shows the gray lines of the global stock market and the blue lines of the global aggregate bond index for the last 33 years. In the vast majority of cases, in years where stocks are down, bonds have actually been positive. But you can also see that when stocks are up, bonds typically don't keep up with them. Bonds are rarely the place to invest for upside potential, but you can think of them kind of like the airbag for your portfolio. So when stocks have declined the most, bonds have added some cushion by declining less or even going up in those years. A balanced approach of maintaining some stocks and some bonds might not provide you with the most upside potential on your portfolio, but it might just be able to buffer the downside enough for you to stay in your seat and stay invested that whole time, so that when the next periods of positive returns come, you're already going to be there and you don't have to worry about getting the timing right of when to get in and when to get out again. So is there going to be another 10% stock correction sometime in the future? Yes, absolutely, I guarantee it. But no one knows when that is going to be. Being prepared mentally and financially with an allocation that you can stick with in all weather will be the best strategy to ensure that you get the most upside from the markets while not making bad decisions in the inevitable downturns that will come. Now, if you think you need to have positive returns every single year, you might want to consider stress testing your portfolio so you can see how much wiggle room you have to take some of the emotional pressure off of your investing experience. So check out this video for a few ways that you can stress test your retirement plan for free. For those of you who made it this far, I think you're probably going to like my channel. So clicking like and subscribe will make sure that YouTube sends you any videos that I make in the future, and also lets YouTube know that this video might be something interesting for someone in a situation like you, and so that helps me a lot to reach more viewers just like you. Thanks so much for watching, and we'll catch you on another video.